So what I wanted to do today was to give you a sense of what mainstream investors are thinking when they think about responsible investment or environmental, social, governance, ESG issues. And it might be slightly different from what people would expect them to be thinking about. So I wanted to bring you into the world, if you're not familiar, the world of the mainstream elements of responsible investment, just so you get a better understanding of the discourse, the arguments, where investors are, so it gives you a better ability to interact with them on those mainstream aspects. So the first, let me just, my arrows aren't working. Let me just go to the next.
Whilst you're finding your arrows, one thing I'll just say, James, is, guys, as you, all the task force members, I think you all know this, but if you just scroll to the top of your screen, there's a chat function. If you have questions as we go, post them to the chat function. I'll collect them and I'll put them to James once he's finished his presentation. It can be quite a helpful way of just collecting thoughts as we run through. So, James, back to you.
Thanks. So it's really important to understand there's a whole spectrum of areas of responsible investment, right from traditional investment, which has no consideration of ESG issues, right through to impact and philanthropic type approaches. And it's really important to understand the difference, because there's a lot of misconceptions out there that, a lot of what we talk about in mainstream responsible investment is actually more on the philanthropic or sub-market return level. So it's important first to define that when we talk about responsible investment, we're talking about responsible and sustainable investment, which are the two columns to the left of the Bridges Ventures spectrum, where we're saying responsible investment is a focus on ESG issues, looking at how these issues can integrate into investment processes. Sustainable investment, focusing on ESG opportunities through investment selection and so on. So really it's a combination of risks and opportunities. It's focused on being a better investor. It's focused on leveraging the trends of the future and for the purposes of in effect, investment returns. And the difference between traditional investment and responsible or sustainable investment is really traditional investment approaches simply don't consider many of these issues because they don't believe them to be relevant or material. And responsible or sustainable investors recognize that these issues are the issues that are going to drive value into the future. So they are actually material, and that you can be a better investor if you incorporate these. Moving across the spectrum, you get more focus on the impact, and you have thematic funds which may have some impact elements, but they might also be sort of very much focused on financial returns as well. But they are actually investing funds into industries which have a demonstrable contribution to sustainable development. So they have more direct impact. And then you have the impact first, which often there's some trade-off between financial returns and impact returns. And, the development finance institutions and social investors are using investment and business strategies, but the returns are not as high as perhaps the market return would be for that type of activity normally. And then across the other end is obviously philanthropy, which is 100% impact and not looking for returns. The PRI and the conversation that we've had over the last 5 years has really focused on responsible investment and sustainable investment. And I'll just take you through where we've come. So the PRI was a UN-initiated project. It was launched by Kofi Annan in 2006 at the New York Stock Exchange. And it was really an attempt to try to leverage the synergies between long-term institutional investors and the goals of the UN through capturing that notion that over the long term, environmental, social, good governance, all of these issues are actually where things head. And all of the same arguments that we have in the, Michael Porter's shared value and the core rationales for corporate responsibility in terms of risk management, leveraging opportunities, all of those can be mapped directly onto the investment part of the chain, and that was really the goal of the PRI, was to do that. So it's very much a process set of principles. We didn't focus on the content in the way that the UN Global Compact did, for example. Investors were very new to this agenda. Apart from the SRI industry, or the ethical investment industry, which is a relatively small part of the industry, the great bulk of investment funds, 98% or more, were very new to this agenda and significantly behind the corporate sector in terms of their recognition of the relevance and importance of sustainability. So all the advice we had was focus on the processes and get investors working with these issues in their own way, focusing on the most material, the most relevant, and then that will push the agenda along. So principle one of the PRI was to incorporate ESG issues into investment analysis and decision-making processes. This is the due diligence phase. This is when you're looking at buying a company or investing in a property or infrastructure or whatever it is. Make sure you fully understand the whole set of risks and opportunities around that investment. Now, it might be a poor performer on some of those issues. That doesn't mean you can't buy it. The PRI is not prescriptive in that sense. It might be very cheap. But what we're saying is that understand whether there are human rights issues in the supply chain, understand whether there are community relationship issues in a mine site, understand the risk of corruption within that company or that sector, then make your decision. And that's a very big change from where a lot of traditional investment managers have been in the past, where they simply didn't consider those issues were relevant or material until, of course, they blow up when then they hit the share price and then it's obvious that it's material. What we're saying is that many of these issues are core risk issues which need to be managed by companies. They are being managed by leading companies. And investors should be taking into account which companies are leading on these issues and which are not. Principle 2 is about being active owner and incorporating ESG issues into ownership policies and practices. This is stewardship. Once you own something, then you should act as a good steward. And if capitalism is to function effectively, shareholders need to hold companies to account. Now, what's happened over the last 50 years is that shareholding has become more and more diffuse, with very few shareholders owning more than 1%, certainly institutional shareholders, very few of them owning more than 1% of a company, many owning fractions of 1%. So there's a problem in the chain, in the accountability chain, because there's no incentive if you own 0.1 of 1%. There is little incentive for you to make a huge effort in monitoring and holding managers to account. But this causes the types of problems we saw in the financial crisis, where there is simply a lack of accountability from companies to their shareholders. And so principle 2 of the PRI is all about active ownership and ensuring that investors, either collectively or if they're big enough, have their own resources to go and engage in dialogue and make sure that the companies are acting in the best interests of shareholders over the long term. The other principles are really about transparency, ensuring that these issues get promoted throughout the investment chain, collaboration and disclosure. So we have now actually over 1,100 signatories with about $32 trillion in assets signed up, which is about 15% of the global capital markets. That's stocks and bonds combined. it's more than that. It's about 25% of global equity markets being managed by our signatories. So it's actually a very large proportion. But many of those assets are still in very early stages of implementation. So it's a high-level commitment, but we work with our signatories to really encourage them to implement in a much deeper way. So that's the PRI as an initiative. I wanted to turn now to dig more deeply into what do we mean by responsible investment, and this is from a mainstream sort of perspective. So ESG analysis with individual investment decisions based on the belief that such analysis can materially affect the investment's financial performance, some kind of screens or screening processes, again, focused on what might be material, how to deliver outperformance. From an asset owner perspective, that is the pension fund perspective, it's integrating ESG issues into the selection of your fund managers. When we say integration into manager selection, we mean when a pension fund outsources its fund management to asset management companies, integrating these criteria into the contracts and the request for proposals between the pension fund and the fund manager to ensure that the fund manager is acting in the best interests of the pension fund. So what sort of issues are mainstream investors focusing on? Well, climate change is a huge one, and I think we've seen a lot of data come out of the recent Doha conference, new reports coming out which not only affirm but enhance the salience of that issue as something that business and investors should absolutely be thinking about very carefully and taking action. Environmental policy, sustainability best practices, a whole range of areas, and it's very context specific. In some sectors, some issues are material, in others, other issues. So in media, for example, climate change or greenhouse gas emissions may not be the key driver, but if you look at issues around News Corporation and most recently the Australian radio station involved in the prank call, issues around media ethics and the behaviour of journalists is absolutely material to media companies. So it's important to recognise it's not one size fits all. Different issues are relevant and material to different sectors. And those companies, well, certainly not all of them, but leading companies understand which issues are material to them, and the leading companies take them very seriously. But the laggard companies often don't. And so what we do is we work with investors and we encourage investors to engage with those sectors on the issues where the leading companies are clearly demonstrating that these issues are important, whereas the laggard companies are perhaps missing a beat. So ESG integration, well, what are the drivers? Risk management is the most persuasive rationale for ESG integration. You can really help identify red flags or demonstrate that some companies are at real risk. ESG research can dig up issues that conventional fund management processes may just miss, or black swan events. So most black swan events are too infrequent to be able to be integrated into models because they just don't happen very often, if at all. And yet you've got to be able to think about these issues because that's where most of your money will either be made or lost. And if you look at the returns in equities markets, huge amounts of the returns are made in very small number of events or occasions over a very small number of days. And if that's a downside event, like the BP oil spill or the Lonmin issue, these are things which ESG research can help give a lens into. Now, you're never going to prove or demonstrate that companies are going to suffer these issues, But what you can demonstrate is that some companies manage them better than others. That's absolutely without doubt. So what you can do is you can, in the investment side, you can underweight slightly the ones who are managing it poorly. You can overweight slightly the ones who are managing it well. Or you can have a dialogue with the ones who are managing them poorly to encourage them to improve. So ESG integration also around leveraging megatrends. I think megatrends, whether they be resource constraint issues, global supply chain issues, these things are more important now than they ever have been. The world is going through a resource constraint period and will increasingly be doing that. And traditional investment models often just don't think that deeply. Now, the best investors do, and often the best investors don't even know they're doing what we're talking about in terms of responsible investment, and they probably don't even know about PRI or the acronym ESG. But there are some very good investors who are doing exactly what we're promoting, but our point is many are not, and this is the way that we're trying to demonstrate that. So the academic evidence, while 5 or 10 years ago, I think the academic evidence was much weaker, and it was focused pretty much on, do SRI mutual funds outperform non-SRI mutual funds? Now, things have got a lot more robust since then, and we now have, rather than just comparing fund to fund, because that is aggregating a whole lot of different reasons in terms of including, fund manager skill and so on. What a lot of the academics are doing in more recent years is focusing on very specific factors and working out which factors lead to outperformance or underperformance, and how and why might that be. And I think what we can say, without a doubt, is that ESG issues have been material in particular sectors, particular themes, particular issues. There's just no doubt they have. There's no doubt that they are material, but what is difficult is you can't project going forward which ones will be material, and alpha generation is incredibly challenging at the best times, and you can't ever claim to say, well, this will lead to outperformance. But what you can say is that these factors have been underexplored in the past. They have been found to be material in the past. There will be other issues which will be material into the future. So you should be looking very carefully as a fund manager at which ones will or may not be material going forward, which is a damn lot more than a lot of investors are doing right now. So the academic evidence, corporations with better employee relations or proactive environmental management practices are found to have lower cost of debt and higher credit ratings. Companies with higher ESG scores are found to have less company-specific risk, and ESG criteria are found to provide an insurance-like protection for firms in legitimacy crisis. Well, that's kind of obvious. If you put a lot of work into your ESG programs, you're building up a buffer, and then if something bad happens, well, of course, you can draw on that, legitimacy capital that you've built up over the years. Excellent study by Eccles and Seraphim at Harvard Business School. High sustainability companies significantly outperform their counterparts over the long term, both in terms of stock market and accounting performance. So I think the key point is many investors over the years have traditionally said, well, we don't do this responsible investment stuff because it will reduce our returns. I think what we can say clearly now is that integration of ESG issues as part of a serious fund management process where the intention is to leverage the issues which are contributing to value going forward. Not only are you not going to lose money, there's a very good argument that if you do it well, you'll outperform. So what does it mean, ESG integration? Well, it's very much a holistic fund management process. You look at the economy as a whole and understand how particular ESG issues and themes affect GDP, macro themes, different countries. Then you look at the industry, understand how they influence consumer preferences, regulatory change. You look at company strategy, how the particular company manages ESG risk compared to its peers. Then you look down more at the valuation side of the companies and the profit and loss and balance sheet and cash flow, and there are different ESG issues that can factor in through there, and that's the sort of more typical fund management valuation process. And all of that is a holistic investment approach which the very best investors in the world do. And what we're arguing is that ESG issues are a core part of that mainstream process and should be encouraged across the industry. So what's active ownership? Exercising voting rights, monitoring compliance with voting policies. That's voting at annual general meetings of companies. Filing shareholder resolutions where appropriate, engaging with companies in dialogue on ESG issues, participating in collaborative engagement initiatives. Again, to my point before, that collaborative engagement is required if shareholdings are so diffuse that there are no big shareholders. Everyone has to get together. And participating in the development of policy, regulation and standard setting. So that's a really important part of being an active owner. So again, the academic evidence, there's an excellent paper that's just come out weeks ago by Elroy Dimson from London Business School, a very well-respected finance academic, who demonstrated that over a 10-year period, shareholder engagement with companies resulted in 4.4% outperformance for successful engagements, and this was with F&C, which is a leading shareholder engagement service provider and fund manager who's been doing this for many years. So what that demonstrates is that if an investor can improve a company's behavior in some way, and in this case, it demonstrated that corporate governance and climate change policies and processes were the key areas. You can get a 4.4% outperformance because of that shareholder engagement. So that provides a very strong rationale for having shareholder engagement capability within your fund management or pension fund organization. Because if you can deliver a 4.4% outperformance on the companies where you have a successful engagement, and you're a fund of tens of billions, if not hundreds of billions of dollars in assets, then it's a very small amount of investment in staff time in order to achieve a very good return on investment. There's also a big trend that responsible investment is broadening beyond equities. Now, it's always been in property. Property has been very aware of sustainability issues for many, many years. But what we're seeing now is a very concerted effort to look at which ESG issues are relevant in fixed income. We now have PIMCO signed up to the PRI earlier this year, the biggest fixed income manager in the world. And they are on our steering committee who's looking at both corporate and sovereign fixed income and ESG factors that might be relevant there. The private equity industry has really stepped up since the financial crisis. They are much more interested in looking at sustainability issues and how they affect their underlying companies. Infrastructure, of course, has always had quite a strong focus on communities and sustainability. Commodities and farmland is an increasingly important area. A lot of that is based around reputation. Large pension funds really don't want to be accused of causing food price spikes or land grabs, relocation of indigenous people, and obviously, if that goes wrong, then your land can be taken, and there's a huge financial risk there as well. So that's one that's coming up the agenda. And of course, inclusive finance, microfinance, and impact investing. So what we have done to leverage this trend or movement around active ownership is we've set up what's called a PRI engagement clearinghouse. So this is engagement between investors and corporations, collaborative engagement where investors come together and pool their resources, pool their influence, come up with issues of common concern around corporate behavior or issues that need to be explored, and then go and have a dialogue, a structured, informed dialogue with the companies to ultimately seek some form of change or improvement in company performance. And this is really the platform to try to solve that collective action problem that I spoke about before. We have half a dozen staff who work together with coalitions of investors, trying to make it easier for them to engage with companies, come up with those issues of concern, do the background research, if necessary, that they need to do to identify which issues are most material in particular sectors, which companies are most at risk and would be best open for a dialogue, and so on. So we have all kinds of issues that have been focused on over the years, and we have about 15 going forward at any one time. I wanted to just, in the last couple of slides, focus on the role of public policy. Now, investors have, for the first time this year, through the Rio Plus 20 process, called for a global agreement on corporate sustainability reporting. And I think this is really, really interesting. Nobody would have imagined 5 or 10 years ago that investors would be actually lobbying governments at UN delegations to demand a framework for mandatory corporate sustainability reporting. But that's actually what we got this year. We had a coalition of investors led by Aviva investors representing more than $2 trillion in assets, saying to governments of the world, we really want you to adopt a mandatory sustainable corporate sustainability reporting framework. Now, the text that came out of the Rio Plus 20 was not very strong, as I've put up on the screen, but it's a lot more than was there in the past. So while a lot of people were disappointed with this result, we certainly a lot of our investors were pleased that it was put on the agenda for the first time, and it's really a starting point. So I'd like to wrap up there and open it up for questions.
Thanks very much, James. That was great, and we've got a good turnout actually today. About I think looking at the numbers, about 23, 24 of the task force. So there's a few questions coming in. Let me kick off with one. I mean, one of the things that so the world you described of investing, and particularly mainstream investing, I heard you talk about a few different lenses. There's the risk lens, there's a responsibility lens, and and there are different ways in which different types of investors and different parts of the spectrum look at this issue. What do you think the extent is to which investors are looking at future market opportunities or future business model opportunities, for example, in tapping into new areas of innovation that tackle big sustainability challenges but also create new markets? Is that a feature you see?
Absolutely. what I would say is that that part of the market is still pretty small. So there are some large pension funds who do invest in that type of activity, but they do it through their private equity funds. So their infrastructure funds would invest, for example, in renewable energy generation, very large scale, wind farms and so on, with government guarantees and that sort of your 6 to 8% returns. But on the private equity side, that's where you would get the innovation. The problem is that it's very small. It's a very small part of the asset allocation compared with listed equities and fixed income, and so it's that innovative niche of clean tech and private equity, which is focusing on that area, is only a relatively small part of the whole institutional investment world, and I think it's a hugely important part, and I think that it should be very much encouraged. And we have a work stream within our implementation support team on environmental and socially themed investment, where we're working with particularly asset owners, pension funds, to look at how they might explore these areas more. But I think it's still, in the mainstream investment world, it is still a small part of the overall discourse.
Mm-hmm. And from your experience and your rich sort of this set of discussions that you have with these different types of investors, I mean, for that to scale, I'm not thinking just solely about the sort of circular economy and the sort of elimination of waste and those sorts of value chains, but let's say more broadly that positive lens of future market opportunities and being able to screen businesses based on their ability to tap into those new markets. I mean, what needs to be true for that to go to scale?
It always comes back to the business case. These investors, most of them the pension funds are fiduciaries. They are looking for large-scale investments that can fit into their asset allocation models. The smaller private equity players are looking for, really strong businesses. And I think the business case and the deal flow needs to be there. And whatever the industry can do to make that happen is really where the focus needs to be. There's a debate, there are different views about where the bottleneck is or where the bottlenecks are. Some people say, well, if the pension funds were to commit more funds, then we could invest those funds, with commercial rates of return. Others say, well, actually, no, the deal flow is quite limited and there's just not enough large-scale deals happening to soak up the huge amounts of institutional investor money that is actually looking for returns in what some argue is a low return decade. And there's probably truth on both sides, but I think if the deals are there, then they will get funded. I think where that's not necessarily true is there are some brackets of the market where they don't quite fit. It's bigger than what social investors or philanthropic investors and foundations would invest in, but it's too small for the larger private equity firms or the larger pension funds to invest in, and that's where there's probably a role for intermediaries who can fund those sort of mid-sized businesses and get them up to scale. But I think the deal flow is ultimately the challenge, and a lot of it comes down to public policy. If there is a price on carbon, then suddenly a whole lot of businesses become viable that may not have been before that. If there are feed-in tariffs that people can trust, and they're not going to be sort of removed next time there's a fiscal tightening, then then people will have more faith and be willing to invest.
That makes a lot of sense, James. Thank you. So some questions from some of the callers. So the first one from Serge. Some contacts I have in hedge funds and pension funds are interested in ESG, but as they don't often invest directly, how can they ensure that they do, in inverted commas, responsible investment?
Well, this is a really big part of what we do because we work with pension funds, most of whom outsource their funds management to others. So there's an entire area of best practice which is around outsourcing funds management. So it's all about how do you interact with your fund managers. And we've had a working group for a number of years between LPs and GPs in the private equity industry, the LPs, the pension funds, and how they interact and what sort of reporting they would expect from the LPs, the private equity firms, and what they should be reporting back and how they can demonstrate that they are being responsible investors with their clients' money. So we have an asset owner tool coming out in January or February, which will go further along in terms of best practices and case studies. ICGN, the International Corporate Governance Network, put out an excellent paper on mandates, investment mandates, incorporating ESG criteria into those mandates and selection processes. So the whole area of how to outsource your funds management, how to monitor, how to interact with your fund managers across asset classes is a very vibrant debate and an area of best practice. So it's you don't have to be a direct investor to be a responsible investor. You can exercise responsibility through the way you interact with and select and interact and monitor your underlying fund managers.
And are there resources and sort of toolkits of a sort on and links on the UNPRI sites? Is that
so we have a publications page on our site which has a whole range of resources, and we'll have another 5 or so publications coming out in the next 2 months covering asset owners, ESG integration, where we've worked with brokers to look at material ESG issues and processes. We have a publication looking at farmland. So there's quite a lot out there now in terms of best practices and checklists and what you should be thinking about.
Great, thanks, James. So I've got a comment here for you, which is just an aside from Franz, who says, being from Canada, I have to comment, smiley face, that the location of the oil sands on the graph is off by a few thousand kilometres. So that might be one for your slide. Now, moving on to another question from Susan. When do you think we'll see greater uptick on these topics during investor calls? When will the topic jump that chasm?
Well, I guess that's a good question. And at the end of the day, there are some leading portfolio managers and analysts who are focusing on these issues in their conversations with companies directly. And it's a bit of a chicken and an egg because a lot of the time the companies are dealing with these issues all of the time internally, and they don't feel that the investors think they're relevant, so they don't raise them on calls with investors. On the other hand, the investors don't think they're material because the companies aren't raising them on the calls with them. So it's a bit of a chicken and egg situation. I think it requires both the companies and the leading investors to be raising issues that are material and key strategic areas of company activity that could loosely fall in the ESG box to be able to get that dialogue going. Now, one anecdote from a very large US active equities manager has about 24 boutiques within the fund. They hired an ESG person full-time for the first time last year. That person now goes to not every company meeting, but many company meetings and asks tough questions of the companies about their sustainability strategy, about their human capital, about supply chain risk, all sorts of questions that are very well researched. And the portfolio managers or the analysts who are there are hearing these questions themselves for the first time, and they're thinking, wow, well, that company responded really well. They clearly know what they're doing when it comes to supply chain labor risk. That other company really wasn't on top of that. And so that adds a level of context to the question of, company quality of management. And when that sort of insight starts coming through to the portfolio managers who are actually making buy, sell, hold decisions, and they start valuing those types of tough questions and that lens through which to look at company management, then they'll start doing it a lot more themselves, and investor relations people will start to recognize that, well, we better get onto that question for next time somebody asks it. So, there's no silver bullet. It's about having those conversations over and over again and building support for a much deeper and longer term investment philosophy.
Thanks, James. That's very clear. So a question in from Rob, which I'm guessing you must have heard before. When you look at this issue of corporate responsibility, greenwash is often an issue, particularly companies investing small amounts of money in initiatives themselves, but a large amount of money on marketing these initiatives. How much of a motivation does this play in driving participants to follow PRI versus a strict motivation of maximizing returns, do you think, in your experience?
Well, there's a complete spectrum. And, for us, the goal is to drive responsible investment and get more institutions implementing the PRI. And some of them would start off from a reputational perspective, and normally it's a journey, and often the journey does start off there. And it was exactly the same with corporate sustainability, 10 or 15 years ago, and now the leading companies. It's a core part of their strategy and their philosophy. And I think, if we're seeing progress, I think we should commend that and be positive about that. And we need to be quite open and recognize that reputation is an important part of the driver for being a more sustainable organization, whether you're a company or an investor. And you have stakeholders who are important. That said, everything we do within the PRI community is based on a strong business case. And I think this has got to be at the heart of the main rationale for being a sustainable investor. And the fact is that there's some pretty strong arguments for corporate sustainability and for investor engagement in ESG issues more broadly, and that's what we want to encourage. In terms of the PRI's own integrity measures, we have an annual reporting and assessment process. We've just rebuilt that from the ground up. It's a very thorough process, and from 2014 onwards, it will have a mandatory transparency element where probably about 40% of the framework will be mandatory to publish to the public. In the first few years of the PRI, we had about 35, then 70, then 135, then over 200 of our signatories reporting on their responsible investment activities. From 2014 onwards, it will be all of the investor signatories, which will be probably over 1,000. And this is, and that is that 15% of global capital. So even if our signatories are at earlier stages of implementation in many areas, from 2014 there will be a global standard for responsible investment reporting, which will be mandatory, and will let those signatories go if they don't want to participate in that process. And so really the PRI will have stimulated a huge shift in transparency around responsible investment processes in a fairly small number of years. We also have an assessment element which will look at best practices that will be private to the investors, just because there's still a lot of question about different types and different approaches. But that will be something that clients, so the pension funds, will start engaging with their fund managers about, and ideally embedding responsible investment capability in the contracts between pension funds and fund managers. And if we can encourage that type of embedding of this into the business of funds management, then that will be incredibly powerful and have a really strong accountability benefit.
No, that makes a lot of sense, James. Look, so I think there's a couple more questions, but I think they're quite similar questions. So, I mean, just in wrapping up, where do you see the next 5 years in terms of responsible investment?
I think it probably is going to be a decade of challenging returns. So the focus, there are a lot of underfunded pension schemes. There will be a lot of focus on firefighting. So I think that will sort of hang over the industry. So I think there'll be, over the next 5 years in the responsible investment space, we will move to a point where it is considered, pretty mainstream. It's not considered something that's niche. I think we will have won the argument that these issues can be material and should be integrated in a systematic way as a part of a holistic investment process. I think we will have won the argument that says that investors need to be active owners and they need to actually proactively monitor and engage in dialogue with companies to ensure that they are managing these risks well. So on the core elements of the PRI, I think in another 5 years, we will have really broken the back of those core arguments. In terms of mobilizing capital for the green economy, which I think a lot of people on this call are most interested in, I think it's a real challenge. And I think unless we have the public policy frameworks that can almost release the capital to flow, it's going to be very difficult. I think there will be innovation. There will be a lot of good fund managers out there, and there will be a lot of good businesses out there. But I think if that capital needs to be, or if we want that capital to be mobilized at the scale and speed, particularly around issues like climate change or other, particularly environmental resource issues, it's going to need a step up in terms of the public policy side of things.
Great way to finish. Thanks, James. Listen, that's been hugely helpful, and it's provided an angle, I think, for the task force that we haven't covered before, I think, with the investor side of things. And I think although probably the circular economy feature itself is possibly too granular for more than some of the niche approaches at the moment, I think it'll be interesting to watch how that evolves over time. I think also it's difficult to separate out some of the bigger businesses who are investing in some of those technologies and some of those market areas from their broader business, because there's only one small part of their broader portfolio. So I think that's something that we'll have to sort of watch in terms of evolution as well.